Okay, everybody, today we are going to look at chapter 15 and we're going to start that dealing with accounting for debt and share investments. Okay, so this is from the standpoint of we are a company and we have excess funds that we don't want to just put in our bank account. Why? Because it's not going to offer, if you put money in a bank account, you're not going to get a good return. Okay, so a lot of times what companies will do, again, if they don't need that cash, they will put it in an investment, okay, whether it be shares of another company or debt of another company. So in this case, they'd be buying, say, bonds of someone else, okay? So last chapter 14, we looked at it as if we were the company that was selling debt or selling those bonds to someone else. This is the reverse, okay? So we're that company now with extra money. We're doing well, we don't need it, okay? We might need it in the future, but what we're going to do is, again, we're going to invest in other companies' debt and shares in order to get a better return rather than just keeping it in a bank. So we're going to identify and describe investment classifications, account for and report for non-strategic investments, account for investments in associates, and describe the accounting for business combinations. So we're going to go, if you look on the slides, we're going to start from slide 1 and go up to slide 37. Okay. Now, let's start with the textbook as well. I'm just trying, what happened here? Okay, so again, we're on slide 5 and page 988. So let's look at the different types of investments. So we might have a debt investment, okay, which is also called debt securities. So a debt investment represents an amount owed and arises when one company lends money to another. Okay, again, that would be like a bond. Okay, again, we've covered bonds last chapter. Or we could have a share investment where we have a company, again, that represents one company's purchase of shares in another company. Okay, so again, not only can individuals buy shares of another company, so can companies buy shares of another company as well. Okay, now, we have, once we get into purchasing shares, so that's share investment, we have a couple of different types. We have a non-strategic investment and a strategic investment, okay? So a non-strategic investment, this is where a company may not be looking to hold on to these shares for a long time. Maybe it's under years, so it's non-strategic. The investor cannot significantly influence or control the operations of the investee company. Okay, why can't they? Because they don't have enough shares. So a non-strategic investment, general rule of thumb is 20%. So if a company owns less than 20% of another company, that's non-strategic, okay? Now, a strategic investment, this is where the investee, okay, is controlled by, meaning there's significant influence from the investee, okay, so they can basically control what the investee company is, okay? So the investor has a lot of control this way. So it can be by joint arrangement with the investor, okay? So those are the two types of investments we're going to look at. So first of all, we're going to look at a strategic investment, okay? Or sorry, a non-strategic investment. So companies are going to make a non-strategic investments for a couple reasons. They want to earn dividends, okay? So they'll get paid a dividend on whatever whatever shares they've purchased, or they might be paid interest, okay, if they purchase a bond, okay? Also, why would they want to purchase debt or share investments? Well, eventually they're going to earn a gain, okay? Because hopefully you buy those shares at $10 a share and you sell, maybe if you're holding it for 10 months, you sell it for 14 bucks, okay? That's great. You earn $4 a share profit. Perfect, that's what we want, okay? So again, you're looking for that, companies are looking for that capital gain on their investments. Again, if it's debt, you're going to earn interest for the life of the contract. Now, companies may make strategic investments in other companies for the following reasons. They might want to participate in a new market or a new technology, Okay, one of the ways to do that is by buying between 20 and 50% of a competitor, or not a competitor, but just another company. Okay, now, two, they might want to build up a favorable business relationship with a major customer or supplier, and they might want to achieve non-controlling interest with the investee by acquiring enough shares to influence the investee's decision. So non-controlling interest, you're not controlling the company, but you have enough leeway to influence some decisions. Okay. Or fourth, you can acquire a controlling interest in an investee. We will get to that at the bottom of the chapter. Okay. So non-strategic investments, okay, they may be either debt investments, again, either a bond, or they might be shares. Okay. So when we have a non-strategic investment, what we want to do is on the balance sheet, we're going to classify it as non-current. Okay. Most of the time. However, sometimes it may be a non-current or long-term investment. It really depends on the scenario. Okay. Now, I'm trying to line up the chapter with these slides. So let's go now to slide 11. Okay. So let's deal with non-strategic equity investments. Okay. So here, the investor's intent is to realize profits through short-term changes in fair values, through the receipt of dividend revenue. Okay, so the dividend revenue is secondary. What the company is doing is when they invest in shares on a short-term basis of another company, they are looking for that change in fair value or that capital gain. Okay, so the investment is going to be originally recorded using the fair value through profit and loss method. So let's take a look at the example on page 991. Okay, so we have here, for example, June 2nd, 2020, TechCom purchases 300 Cameco Corporation common shares at $50 a piece plus a $50 commission. Okay, their intent is to hold for between 6 and 12 months. For the purpose of realizing a gain in share price fluctuation, meaning they don't intend to hold it for long term. Okay, so that there gives us an indication that it's non-strategic. Okay, and again, it doesn't say this, but they're buying less than 20%. Okay, so it's going to be a non-strategic equity investment because they just don't have any control. So you can see from the textbook, the total transaction cost them cash of $15,050. Okay, so that's what they paid out to purchase these shares. Okay, so we're going to have investment, Cameco. We always want to signify who that investment or what that company that we've invested in. Okay, if we just put investment, we're going to have no idea. So debit 15,000, and then we had a $50 transaction fee. Okay. So what this has done is, again, we're setting up the journal entry for recording the transaction. Okay. So right now, on our books, that Cameco investment is worth $15,000. Now, what we need to do is, again, we're buying this investment in order to get income, dividend revenue, and an increase in the fair market value. Again, the fair market value in this case here is $50 times 300. Okay, so $50 a share, and we bought 300 shares. Okay, so again, we're going to hope that if we're the investing company, we hope that when we sell, it's going to be, I don't know, 55, 60, 65, 70. Okay, so now what we want to do is we own the shares. Now, again, 3 months later, we're going to get a quarterly dividend. Okay, in this case here, we always have to record the dividends that we're going to receive. So the dividends that we're going to receive in a non-strategic investment are cash. So that assume on December 12th, okay, so this is June 2nd. Okay, so December 12th, what happens? We received a $40 cash dividend per share. Okay, so what does that mean? Well, we bought 300 shares. Now we're getting a dividend. You know, that quarterly payment of, in this case, $120 cash. debit cash 120, and credit dividend income. $120. Okay, so anytime that we receive dividend income, when it is a non-strategic investment, that's the journal entry that we're going to make. Okay, debit cash, credit dividend income, because again, that's obviously what it was. Now, lastly, we always need to do a fair value adjustment at year end. Okay, so what does that mean? Well, December 31st comes along. Okay, so what we need to do right now on our books, we have the investment in Camco for $15,000. Because why? Well, we bought shares at $50 a piece. Okay, well, what are the shares worth now? If they're worth more, we're going to adjust our investment upwards. If it's worth less, we're going to invest it downwards. Okay, so in this case here, we have Techcom, an investment in Camco shares, had a fair value on December 31st of $53. Okay, so it went up. It went up from $50 to $53. So that's a gain of $3 a share. So 3 times 300 is a gain of $900. So what's the journal entry going to look like there? Okay, well, we want to bring the investment in Camco up. Now it's going to be on our books worth $15,900. Why? Because we're going to debit investment Camco. And credit, in the textbook, they say you should credit investment income. Now, in reality, you would call it an unrealized gain. Why an unrealized gain? Because you didn't sell the shares to realize an extra $900 in profit, okay? This is a paper transaction, okay? So, again, but for our purposes right now, we're going to just call it investment income, okay? So, on the flip side, let's just say that the fair value went down to $48 at year end. Okay, well, that's a loss of $2 a share. 2 times 300 is $600. Okay, all we would do is flip this. Okay, debit investment loss. $600 and credit investment in Camco. Okay, $600. Now again, that's all there is to it. Okay, so when we find out it's a non-strategic equity investment, it's fairly straightforward. Okay. Now, lastly, what'll happen is we might want to sell these shares. Okay, so if you look at the bottom of page 992, it says here, assume on January 14th, 2021, Techcom sold 200 of its Camco shares at $52 a share, and they paid a commission to sell of $90. Okay, so in this case here, there's a couple things right off the bat that we know. Okay, we know that, and I'm just going to erase the June 2nd, 2020 entry. So we know from this standpoint of, again, we're going down here up to here now, and that was on June 14th, 2021. January 14th, 21. Okay, so again, we sold these shares for $52 a piece, but we only sold 300 of them, or sorry, 200 of them. Okay, so cash, debit cash of 52 times 200, that is going to give you cash of, they net it out. I wouldn't have done it this way, but it's going to give you cash of 93,000, 10,310. Okay, you have a transaction fee of 90. Okay, your investment income, your gain on the sale of investment is what it really, again, should be called. Well, we'll do that one last, but I want to take out now the book value of our investment. It was originally valued, again, on our books at $15,000 for 300 shares, but we only sold 200. So we're gonna take 50 bucks, because we knew we bought it for $50, 50 times 200 shares, okay? So 50 times 200 shares on our books, let's just do the math on that. Oh, no, I'm sorry. That's wrong. Why is that wrong? Because our new value is not 50 bucks a share. That was our original cost. But we had to bump it up, right? We bumped the if we look at T account, it's 15,000 plus another 900. So 15,900 for 300 shares. So we got to figure it out on a share by share basis. 15,900 divided by 300 is going to give us $53 a share. Okay, great. Now, how much are we selling this for? Okay, again, let's take a look here. We're only selling it for 52 bucks, so we're actually gonna have a loss. Okay, so we're gonna have a loss of, if we sell for 52, we're gonna have a dollar loss on those 200 shares that we own. So 1 times, in this case here, 200 is gonna represent our loss. So we could do this a number of ways to figure out what that loss is. I'm just gonna keep it in journal entry format. Okay, so I know that we're gonna, these shares, $53 times 200, that's 10,600 bucks. Okay, and then we've got to record the $200 loss. Loss on sale of investment. Alternatively, the textbook likes to use investment loss of $200, okay? Now, again, if we would have sold it at a gain of 200, that would have just been over here, okay? So that's how we record non-strategic or gaining an income or a loss on non-strategic investments, okay? Now, from there, let's look at buying debt. Okay. So this is on slide 17. So our focus here, again, and all we're going to do is make these journal entries. Again, we only make this once we sell. Okay. Usually, we're just going to make always our dividend income entries and our fair value adjustment entries. Now, if we go to non-strategic debt investments, okay, now this is on page 993, we're going to focus on the fair value through profit and loss method, okay? So again, that's on page 993. Now, the fair value through profit and loss method, what we do there is the initial purchase is recorded as the purchase cost, but we don't include any transaction costs, okay? Any investment income or loss arising from the fair value test, again, at the end of the year, is recorded on the income statement. So we would either bump up the debt investment or reduce it, okay? And then we'd record either a gain or a loss to balance out the journal entry. And what we're gonna record on our balance sheet is the fair value. Okay. Now, let's look at an example and we'll follow along in the textbook. Okay, so we have here, we're going to acquire this bond. So on September 1st, 2020, TechCom pays $29,500 plus a $120 transaction fee to buy Power Corp 7% bonds, okay, that are paying, these bonds are paying 77% and have a par value of $30,000, okay? So interest is paid semi-annually on August 31st and February 28th. The bonds mature on February 28th, 2021. So it's kind of odd to hold it for such a short maturity period, but we'll just use the example that's in the book. Okay. So again, what we want to do is, in this case here, we're buying a bond for $29,500. It doesn't matter to us that the par value is $30,000. We paid $29,500 for it. Okay, so we're gonna make the following journal entries. Now, I don't like the way they combine it. I would have done it this way. Investment, Power Corp, $29,500, credit cash, $29,500, and then I would have made another journal entry, transaction fee, debit transaction fee in the amount of $120, and credit cash. Okay. You can see what they did in the textbook. They just combined it all together. Now, we want to record our payment of interest. Okay. So if we, in this case here, it looks like our fiscal year end is December 31st. Okay. So we bought it on September 1st. So we want to record on December 31st 4 months worth of interest, an accrual. Okay. So in this case here, 7% times 30,000 times 4/12. Okay. So that'll be $700. Okay. So how do we record this? Debit, accrued interest. What's the exact terminology? I would have called it accrued interest receivable. They just say interest receivable. Okay. So the first entry that we're going to do on December 31st is record the interest income. So we're going to earn 4 months worth of income for this period. However, the company is not going to pay us until February 28th. So we'll get interest receivable, interest income. Okay, so in this case, it's $700. Now, we also have to do a fair value adjustment. Okay, so in this case here, the bond is trading for $29,600. So December 31st, if the bond's trading for $29,600 and we bought it for $29,500, well, we want to increase the value of our investment. Okay, so in this case here, it'll be debit, and you can see from your textbook, debit investment, Power Corp, $100, credit investment income. Okay, so now we've got it recorded on our books, the bond at its fair market value. Very important. Okay, so we're just going to do this entry here again. December 31st, investment, Power Corp, credit investment income. Okay, $100. Again, that entry gets it up to its fair market value. Now what we got to do is, okay, we've got to record the receipt of our interest. Okay, so you'll notice that we only have to do this interest accrual once. Then that's on December 31st. Why? Because the next interest payment will be within the fiscal year, so there's no accrual required. Okay, so let's just go now to get the payment of our interest. Okay, again, this is on the bottom of page 994. February 28th, we're paid cash $1,050. Okay, so let's think about that. 30,000 times 7%. Okay, 30,000 times 7% is $2,100 for the year. Okay, but remember, we're getting paid every 6 months. So divide by 2, we're going to get 10,050. Okay, now that's the debit. What's the credit's going to be? Well, we're going to credit interest receivable from here, right here, because we're not going to have the receivable anymore because we're getting paid. And the remaining interest income will be 1050 minus 700, which was the interest earned from September 31st to September 1st to December 31st. So the additional $350 worth of interest income will be earned from January 1st to February 28th. Okay. Now, there's another method. It's called the amortized cost method. We're not going to focus on that. Okay. What I'd like you to do is, again, just understand how to account for non-strategic debt investments, okay, using the fair value through profit and loss method, FVTPL. Okay, so what we've done now, that's enough information to get started on the assigned questions. Okay, and tomorrow we will carry on with looking now at strategic investments. Okay, but again, for now, let's focus on non-strategic investments and go from there. Okay, so the assigned questions, they're attached to the email, and I will see you tomorrow. Oh, and just a reminder, please check in daily. It's going pretty good for most of us, or for most students, but again, just a reminder, please check in daily because I need to submit attendance as well. All right, have a good day.